In March of 2023, a bank with $16 billion sitting in the vault, a bank that had never lost money in 40 years, died in less than 48 hours. Not from a robber, not from a stock market crash, not from some genius villain twirling a mustache in a boardroom. It died from a group chat. Let's rewind, because this story starts sweet before it turns into a horror movie. Meet Silicon Valley Bank, or SVB for short. Picture a regular bank, but instead of serving your grandma and the guy who owns the pizza shop, it served tech startups. Basically every hot startup in California, from the tiny app nobody's heard of yet to the ones worth billions, kept their money here. If you were a founder in Silicon Valley, banking with SVB wasn't just normal, it was practically a rite of passage. It's the fraternity house of finance, and almost half of all venture-backed startups in America had a membership card. Now here's how banks actually make money in the simplest way possible. You deposit your paycheck. The bank doesn't just let it nap in a vault. It takes your money and lends it out, or invests it, hoping to make more money than it pays you in interest. Most of the time, this works fine. But during the pandemic, something strange happened. Startups were swimming in cash. Investors were throwing money at anything with a logo and a Wi-Fi password. So all that cash flooded into SVB. Deposits ballooned from $60 billion to over $180 billion in just 2 years. Suddenly, SVB had way more money sitting around than it knew what to do with. So what do you do with a mountain of cash you don't need right now? SVB's answer was simple: buy bonds. Specifically, long-term government bonds and mortgage bonds. Think of a bond like a savings account you lock for 10 years. You hand over your money, and in exchange, you get a small, steady interest payment until it matures. Boring, safe, practically risk-free, right? Well, there's a catch. And it's the catch that kills the whole story. Bonds are only safe if interest rates don't move much. But interest rates did move. In 2022, the Federal Reserve started jacking up interest rates to fight inflation, and fast. Here's the analogy. Imagine you bought a house at 3% interest, locked in for years. Now imagine the bank next door starts offering brand new mortgages at 6%. Suddenly, your old 3% deal looks pretty unattractive to anyone trying to buy it off you. That's exactly what happened to SVB's bonds. As rates climbed, the value of their old, low-interest bonds crashed. On paper, SVB was sitting on billions of dollars in losses, not because they lost the money, because nobody wanted to buy their old, cheap bonds anymore. Now here's the twist nobody saw coming. As long as SVB didn't sell those bonds, the losses didn't really count. It's like owning a house that dropped in value. You've only actually lost money the moment you sell it. So SVB just had to sit tight and wait it out. Except tech was also having a rough year. Startups were burning through cash faster than they were raising it. So they started pulling their deposits out of SVB to cover payroll and bills. And that meant SVB needed actual cash, real dollars, right now. Which meant they had to sell some of those beaten-down bonds. Which meant those paper losses became very, very real. On Wednesday, March 8th, 2023, SVB dropped a bombshell. They announced they'd sold $21 billion worth of bonds at a $1.8 billion loss, and they needed to raise another $2.2 billion to shore things up. In the finance world, this is the equivalent of standing up at a dinner party and announcing you're a little short on rent this month. Nobody panics if it's one guy, but everyone starts doing the math on their own wallets. And here's where the story stops being a boring finance headline and turns into something wild. Because the people with money at SVB weren't regular folks with a savings account. They were venture capitalists. And venture capitalists do not sit quietly and wait for news alerts. They have group chats, WhatsApp threads, Slack channels, private Twitter DMs, entire digital war rooms built for exactly this kind of moment. Word started spreading Wednesday night. One prominent venture capital firm reportedly told its portfolio companies, quietly and directly, to pull their money out, just in case. That message didn't stay quiet for long. It got forwarded, screenshotted, and copy-pasted into a dozen other founder group chats within the hour. Picture a single match dropped into a room filled with gasoline, except the gasoline is a few hundred panicked founders all staring at their phones at 11 p.m., all reading the exact same message. Pull your money now. By Thursday morning, it wasn't a rumor anymore. It was a stampede. Except nobody had to leave their desk to join it. In the old days, a bank run meant crowds of people physically lining up outside a building, banging on the doors, demanding their cash. This time, the crowd was invisible. It was thousands of founders sitting calmly at their laptops, clicking one button: transfer funds, confirm, done. No shouting, no shoving, just quiet keyboard clicks that added up to the fastest bank run in American history. In a single day, customers pulled $42 billion out of SVB. Let that number sit for a second. $42 billion in about 10 hours. That's roughly $1 million leaving the bank every single second. For comparison, during the entire 2008 financial crisis, the biggest bank failure before this one took days, sometimes weeks, to unravel. SVB did it before most people even finished their morning coffee. By Thursday night, SVB's stock had cratered by 60%. Panicked calls flooded their customer support lines. Founders who'd been calmly building apps and pitching investors 24 hours earlier were now frantically trying to figure out how they'd make payroll if their company's entire bank account had just vanished into a regulatory black hole. And here's the darkly funny part. Some of the very people warning others to pull their money were the same people who'd spent years advising these startups to trust the system and diversify later. Turns out, when the fire alarm goes off, everybody sprints for the exit at the same time. Advice be damned.
By Friday morning, March 10th, it was over. Regulators stepped in and shut the bank down before it could open its doors for business. Just like that, the 16th largest bank in the United States, a bank that had survived dot-com crashes and recessions and decades of Silicon Valley chaos, was dead. Not from bad loans defaulting, not from some rogue trader losing billions on a bad bet. It died because everyone with money inside it heard about the risk at the exact same moment, through the exact same channels, and reacted at the exact same time. Here's the part that should genuinely scare you. This wasn't really a new kind of disaster. Bank runs have existed for centuries. What was new was the speed. In the 1930s, A bank run might take days to build as word spread by newspaper and word of mouth. In 2008, panic spread over weeks through television and financial news. In 2023, it spread through a chat bubble with a blue check mark at the speed of a group text. The bank didn't die because it ran out of money in some literal warehouse. It died because trust, the one thing every bank actually runs on, evaporated in the time it takes to read a text message and hit send. The aftermath rippled fast. Regulators scrambled to guarantee that every depositor, even those far above the normal insured limit, would get their money back, terrified that if they didn't, panic would spread to other banks within hours. 2 more banks, Signature Bank and Silvergate, collapsed within days, swept up in the same wave of fear. For a moment, the entire banking system felt like a row of dominoes standing just a little too close together. And maybe that's the real lesson buried inside this story. For most of history, money moved at the speed of paper and people standing in lines. Now it moves at the speed of a notification buzzing in your pocket. The vault didn't get robbed. The bricks didn't crumble. A message was typed, forwarded, and believed, and an entire financial institution ceased to exist before most of its own customers even finished reading it.